Hello, everyone. Welcome to Beers with VCs, where we have casual conversations about the less talked about aspects of venture capital and startup building. We're your hosts, Sabrina Passman and Simon Lancaster, and today we're honored to be joined by Winter Mead. With over a decade of experience in private equity and venture capital, Winter has channeled his extensive knowledge into becoming a leader in supporting emerging managers. He is the founder of Coolwater Capital and has successfully launched over 200 emerging managers in just the past 4 years, and authored one of the best books in the field, How to Raise a Venture Capital Fund. We are thrilled to have you on, Winter. Welcome to the podcast.
Thanks for having me.
Woo-hoo.
Welcome, Winter. Welcome.
This is
very exciting. Long time coming. That's right. There we go, Serena. We didn't even prep that. And we've got a special guest today. Chewy has joined us.
Oh, nice.
Will not be drinking beer.
Yeah.
I have to say that countdown never gets old. But
I love that countdown. Cool. It's like Headspace.
Yeah.
It's like I was relaxing. I closed my eyes. I took some deep breaths. Like I want that before every podcast.
We should do it. Okay, well, what's everyone drinking today? I have a boring one today, but I think it's exciting. It's my first fall coffee. Has cinnamon in it. Ooh. I'm very excited about it. So, yes. How about you guys?
Nice. Spice of life. I have another boring one, water, but I've spiced it up with some salt, some maple syrup, and some lemon.
Oh, are you on like a cleanse?
A couple of it's kind of like a Beyonce diet, but
yeah,
not quite not quite a cleanse, but it tastes good.
What does the maple syrup do, Winter?
Makes it drinkable, probably.
Yeah, lots of micronutrients. Sweetens it a little bit. Manganese, like things that you get out of like potassium, things you get out of like a banana, helps like prevent cramps during the podcast.
All physical
things you get out of a tree, I guess.
Yeah.
I am staying true. I think I've only done one non-alcoholic episode so far. That's why I'm always so fun by the end of it. Good old Fort Point KSA. For those of you out there that don't know what a KSA is, I just looked it up. A Kolsch style beer is a mix of American style with German. So it's got the well-balanced bitterness of the hoppiness and the German style, more smoothie wheat type taste. So
fancy.
Cheers.
Wow.
Cheers.
Do Germans do ales?
I guess Austria, German. Yeah, there's like Kolsch. That's what.
Yeah. That's kind of,
or maybe
like Kolsch is kind of where like Germany meets US, right? Like it's a very diverse beer. It's like a very cosmopolitan beer.
It smells malty, which is unusual, right? So I guess that's the main difference. It smells malty, not hoppy, like legitimately.
Yeah.
Which is the German. I said wheat earlier. It's actually malt. It should be malt. I should have said malt.
Yeah.
So the German malt with the hoppiness from the.
Oh man, no. I didn't know I could be so jealous on a podcast, but
yeah, very clean, crisp.
I'm gonna wait for this to ferment. I'm just gonna let some yeast kind of settle in. It's gonna be a long buckle up, everyone. This is gonna be a long one.
I love it.
Okay,
well, getting us back on track, we have an awesome episode today. Winter, you've been pivotal inside of the emerging manager community for the past 4 years, and there are so many things that I would love to share with our audience around like your knowledge base of emerging managers. But I think before we dive into like the actual tips and tricks, you've obviously dedicated a significant portion of your career to emerging managers. Can you walk us through why? Like, what's your motivation for doing all of this?
Yeah, it's a great question. I think the cause is supporting the innovation ecosystem, right? And kind of what is the role that emerging managers play in that ecosystem? And from my perspective, it's very instrumental, right? And this goes back, 7-8 years, but when I started first iterating on this concept of an accelerator for funds and supporting emerging managers, it was thinking about kind of where was the gap in the market, how are kind of these first check writers being supported, and as the venture market matured, more funds kind of came into market, barriers to entry kind of came down. It didn't feel like there was a platform kind of meeting those new managers kind of face to face and kind of presenting an option to support them. So yeah, it was, I think, a number of years kind of iterating on a concept. Maybe it evolved from starting as an LP and then thinking about my role as an LP, as a coach for these managers, and then kind of noticing that the gap was more supporting emerging managers. And then, yeah, one thing led to another, and we've kind of been able to create this platform that supports emerging managers. But yeah, I still believe in the cause. Like, I still think emerging managers are incredibly important for, innovation and technological development.
Yeah, I completely agree with that gap in the market. I think in Simon's and my own experience, we started as engineers and then went over to venture capital because we realized we could have more impact by spreading our knowledge base across multiple companies. And you've done the same, just one level higher, which is so important. The skill sets are totally different, honestly, between where you're living and even like the emerging manager themselves. Like, there's so much knowledge transfer that is needed to understand how to institutionalize and all of the above. So we're very grateful that you've chosen to dedicate your career to this, Winter. Thank you for doing so. And I think particularly in the past couple of years, it's become very apparent that it feels way harder now to raise a fund than it did in previous years. And this has been something that obviously Simon and I have entered in a period where it has been challenging. But I'm curious, given your, over a decade of experience in the venture world, what do you attribute to that change? Like, how has the macro really changed at a large scale?
Yeah, I think we can throw some numbers behind it maybe, but it just doesn't feel that way. Like, the data says it has changed, right? So if you jump back to 2021, right, like that was a year where the data kind of says over 1,500 funds, at least in the US, kind of raised a fund, right, like closed on a fund. And it was, almost twice the size of the .com, like, right, in terms of like dollars raised.
Wow.
So massive year. 2022 was like another kind of massive year. It was like maybe counterintuitively was actually bigger than 2021. Even though 2021 was maybe the peak, but it started to come down, but there were still processes in motion. And so 2022 was, again, counterintuitively bigger than 2021. But those 2 years were like massive, right? So you put 2,000 to 3,000 new funds, at least in the US, like into business, and probably, bigger number kind of globally. And, the numbers for last year, 2023, it's a third of that per year, right? Like, so 1,500, like it's less than 500 funds. So that kind of brings us back to a market that is somewhere between like 2012 and 2014, right? Like 10 years ago in terms of like number of funds being put into the market. Now the size is kind of bigger. Like, we're still in the bull run in terms of like dollars being put to work, because I think a lot of these funds, these like established funds have, become bigger, right? And so the LP's expectation is to, meet that kind of demand that was kind of built up in the run up from like 2020, 2021, 2022. So you see kind of this continued bifurcation of established funds raising very big funds, like these, mega funds, and then emerging managers, right, I think are having definitely a tougher time. I'm going to continue to spew a little bit more data, but from what we've seen at Coolwater, right, like, and this is definitely a debatable point, but from our data, like a $40 to $50 million fund target and raise, like you would actually hit that cap in kind of 2021, 2022 timeframe. Just 2 to 3 years later, it's, a third to a half of that in terms of target. And I'd say it takes 50% longer to like raise that. Right. So I think what that means is expectations have to shift. The data kind of points out that the fundraising market is definitely tougher. And then again, like you go back to the drawing board as an emerging manager and you say, do I really want to do this? Do I really want to do this kind of longer duration? And, how do I stand out against kind of a sea of other emerging managers? And the last stat I'll kind of throw out is, we're easily going to meet with over 1,500 qualified teams this year, for our US accelerator. Those are teams that are, they've done something in their career and they're like looking to raise a fund. They're not all going to be successful, most likely. But that's still a lot of managers that are kind of thinking about doing fund formation and raising a fund. So I still think there's demand there from the emerging manager class to raise a pool of capital and to get into business and, finance these great founders. But I do think it's like a harder fundraising environment. And we're kind of seeing that in the data.
Yeah. I'm really curious as to why the difference has really happened. I have my own theories, but I think the desire for investing in innovation, I feel like in principle, everyone wants to do that. But in practice, we're really seeing a huge drop off. Like, do you have any insights into why people are hesitant around the emerging manager? And, what is the benefit of emerging manager versus a larger, more established fund?
Couple questions in there. I guess like true to the debate last night, I'll kind of answer the question that I want to answer, even if it wasn't asked. I think there's like a few things going on. I think from the LP perspective, there's a big push towards liquidity, and that's from multiple dimensions. So those boom years, right? Those weren't only boom years from investing into venture perspective, but those were boom years in terms of distributions as well, right? So if I'm a high net worth and I've been investing into venture for 5 to 10 years, and all of a sudden I'm getting a couple $100K back per year, right? Small potatoes, maybe you're bigger, right? Like you can kind of adjust those numbers depending on where you are. Maybe you're getting tens of millions of dollars back, right? Maybe hundreds of millions of dollars back. But, you're recycling that cash back into, future commitments. You kind of, have a different kind of expectation of your cash model. But yeah, when, capital markets kind of dry up a little bit, when distributions go down, when the duration of companies gets pushed out, when the economy is a little bit sideways and it's, harder to scale as fast as you're scaling. And it does seem like there's reluctance from private companies to generate liquidity, right? Like you continue to see like a lot of, very large private mega rounds, like the private IPO phenomenon, like seems to continue. So there's a number of dynamics, I think, that kind of add up to, right? Like you had it really, really good because there were investments and distributions and kind of a lot of those distributions being recycled. And now you have fewer distributions, and a lot of those people that, as venture became mainstream over that, call it 10 to 15 year bull run, right? A lot of people were like, what is venture? Like, it should be a part of my portfolio. Like, wow, people are putting up really great numbers. And so I think you had a lot of people turning attention, right? Especially in a low interest rate environment, turn attention to VC, put dollars to work. And they've almost like, until those dollars start being recycled back to them, they can't, or, distributed back to them, they can't recycle that back into future investments. Mm-hmm. So it's almost, I don't want to say people ran out of money, but, there was kind of this bull run. Venture became like, mainstream versus cottage industry. And a lot of people kind of turned their attention to, venture as a, key part of their portfolio. But now you're kind of in the waiting game, kind of waiting for distribution. So like in the last couple of years, like definitely the last year, you've seen a lot of kind of mature funds, turn to secondaries to kind of generate DPI for their own investors as they think about raising their next fund. I'm seeing funds 3 through 5 do that, right? Like, it's like, okay, yeah, let me sell a portion of my best company or a portion of my fund, right? And kind of generate some of that DPI that my investors need to continue to invest into me. So, I think when the times are good, right? Like there's that recycling phenomenon going on. And when times are a little bit tougher, like how do you kind of manufacture that, right? Yeah. So, but yeah, I think there's definitely a premium on cash and liquidity in the current market.
Mm-hmm. I think I want to dive just a little bit into dates and history for the benefit of the audience. I think, as you mentioned, venture became kind of like trendy in the past like 10, 15 years or so. And my impression of the industry, would love your feedback on this, is that starting like early 2012 was when like the first like kind of smaller funds decided to be born. They saw returns in the 2018 to 2021 period that were relatively strong. There were a bunch of IPOs in those years. Everyone was like suddenly very excited about startups and giant exits. And I think what a lot of folks didn't realize as they entered the market at that time was that those were not just overnight successes. They were like kind of 10 years in the making a lot of the time. And when people look at where the returns of the market are happening, they tend to only look at the overnight success stories and think that they also can just hop on the bandwagon and see those overnight. But now, as you pointed to, the low interest rate period between that period of time, borrowing money was basically free. So starting a fund in that period of time was just inherently a lot easier than it is in today's market, in which money is not free by any means. And so I think as like emerging managers are entering the market now, keeping in mind what you've been saying, Winter, about DPI is critical for success and critical for figuring out how to be attractive to the current type of LP that people are encountering the majority of the time nowadays. So the history of this past 10-year window, I think, is super critical to understand the strategy for how to raise effectively today. Having gone through Coolwater program, it's been something that was highlighted to us as well. But I would love to get like a high level overview of like how structuring a fund is different today than it was maybe 5 years ago, or structuring your strategy.
Yeah, great points. I might reframe it a little bit. I'd say some of the smaller funds, right, like really kind of came to market mid 2000s. And right, like it was the same time that kind of YC and others kind of came to market. And from my perspective, I guess the history lesson is like, why did those new firms come to market at that point in time? Because it was cheaper to start a startup. And so like there'd been like this technology shift that allowed, people to put hundreds of thousands of dollars to work instead of millions of dollars to work, right? Mm-hmm. So you could have a smaller fund, right? I feel like that in the modern era, like who we view as like the top kind of brands today, like a lot of them kind of started in that era, kind of post.com.
Yeah.
And then you started to see early successes there, right? Even despite like the Great Recession, you started to see some early successes, but it kind of took time. I think you started to see some big like consumer wins, and then you started to see some bigger kind of enterprise wins. And that really, drove a lot of returns. And that's what I think kind of those bigger kind of, 10, $100 billion outcomes, I think is what drove a lot of interest, right? And that kind of said like, it took kind of venture from, like I said before, kind of cottage to mainstream. And so then you have like, wow, you can actually, generate $100 billion outcome. And then what we've seen even recently, right? It's like you kind of saw, like everyone's seen that graph where it's like shifting. It's like the oil companies and the healthcare companies, but all of a sudden like the tech companies, right? Like you worked at one of them, like they started to overcome in terms of market capitalization, some of the most valuable companies in the world. And so you're like, wait a minute. And then those companies were VC backed in the beginning, right? So it started to like, you just saw these like huge wins, like massive points on the board, and they were VC backed opportunities, right? And then you had like a lot of studies that kind of came out that pointed, again, like data driven, in terms of like number of companies backed by VCs, like in the US public markets was like, I think it's between like 40 and 50% of companies, right? Or by market capitalization. So it's like a massive number, right? And so people are like, wait a minute, there's this huge value creation opportunity. How do we access it, right? And emerging managers, from my perspective, the opportunity is they're some of the smartest teams in the world, right? That understand, from the inside out, kind of how these massive companies were built, right? Because they were working there or they played an instrumental role in like helping build those companies. And, they kind of go from this, they have kind of this pivotal moment where they say like, hey, I've spent, most or all of my career at this one kind of great company. I was there early days, kind of grown up. And now I'm ready to do that for like 10 companies at a time instead of one company, right? Like that's your evolution from going from like operator to becoming a VC. So you have these like really great teams that kind of, again, understand the venture model, which is like hyper growth from the inside out. And I think that was kind of what was happening. There was kind of like this, just this maturation of the industry where people were like, wow, there can be massive wins. And like they kind of saw, from the Silicon Valley perspective, I think the windfall from like the Facebooks and some of these other like huge wins. And so it got more and more interesting, right? From an angel investor perspective, kind of maturing. From an operator's perspective, a lot of people like they would become angels and then they'd build an angel portfolio. And it became a lot easier to become like a sophisticated angel because the barriers to entry, like the platforms were kind of introduced over the last 10 to 15 years. It's very easy to just become a VC. That's why we see like thousands of new VCs per year and probably like even more that are doing kind of SPVs or like continuing their work as angels. And like when that happened, right, like people like venture became known. It was easier to become like a quote unquote like VC or super angel, whatever you're calling them in the early days. And then all of a sudden, right, like what do institutional LPs want, or what do any LPs want? They want kind of a track record. So then you had like the 2005 to 2010, the 2010 to 2015, like barriers to entry kind of coming down, lots of angels because like there was liquidity again in the market, kind of that post-Great Recession, maybe driven off the fact of some of these huge wins like a Facebook. And then you just had these people with like, 5 to 10 years of angel track records that looked incredible, right? So they could come to market and be like, hey, look at me. I've generated 10, 15x returns, right? And then like institutions were like, that's cool, right? And this was a time still in that 2010 to 2014 timeframe. I would argue it was, you could count everyone who was interesting like on a couple of hands, right? But that's like, again, barriers to entry continue to come down, like, understanding transparency of the space continue to go up, more and more entrants kind of entered. And so I think that's kind of represents the last 10 years of the market. And I think from my perspective, when that started to change was like 2015, 2016 timeframe. Because I could go, I'd been in the industry for like, investing for 5 years at that point. And, I obsessed about trying to meet and see like every single venture manager on earth, right? Maybe even the universe. And so like the idea was like how, like there was a year, there's like a year where I was just like, I can't actually, like as a manually driven process, meet everyone. And so I think most LPs have probably felt that, like if there's LPs listening to this podcast, it probably went from being like, oh yeah, there's like 100 people I need to meet every year to like hundreds, right? And then they're like, wait a minute, there's hundreds of people I need to meet. And I'm covering like PE, real estate, real assets, venture capital, right? Like that's my mandate. And like all of a sudden I need to meet like hundreds of people in VC and I have to like cover these other asset classes. It became like, I think that was the challenge, right? And that's not only a discovery challenge, but it's like a selection of where do I spend my time and like a prioritization challenge. And I think that's kind of what faced LPs in kind of the 2015 and beyond timeframe. Like there are just so many funds that were kind of coming to market off the back of, fortunately like successes. And then, success begets success. So some of those early kind of 2000s, they came to market, right? Like it was kind of throwing a dart at a broadside of a barn. Like it felt like if you picked anyone there, like you were successful. If you picked the basket, you were 10 times successful, right? Because there's only like 10 firms to kind of bet on ish. I don't think I'm off by an order of magnitude there, but maybe by, 20 or so funds. But you could pick like a basket and be like very successful, right? Because it was, there was less, I think, competitive dynamics to like access the greatest teams. And now I think for over the last 10 years, the competitive dynamics have gone up. But, fast forward to today, like what's happening, it almost feels like, right, there's kind of a shift going on where there's, fewer dollars being put to work. There's fewer managers starting, but that's almost a good thing, right? Like if you think about kind of the fundamentals of economics, right? Like buy low, sell high, right? If the buy low opportunity is now in today's market, it's actually a good time to start a fund, right? And at least to invest a fund. Like if you can raise the capital, it's potentially more, more attractive to invest now than it was, 2 or 3 years ago. So it's kind of a great time. Again, this is kind of a harder time to fundraise, but maybe potentially like a better time to invest, right? And so again, like you have to kind of take everything in context and kind of really understand kind of where we've come. But yeah, when there's up and to the right dynamics going on, 2015 to 2020, 2020 to 2022, right? Like a lot of people are entering the market to try to like, grip and grab onto kind of the success story. But I think maybe what happened and what's kind of happening to address another point of like, yeah, why have some LPs become a little bit more skeptical of venture capital, right? That kind of late 2010s, early 2020s behavior of, and this is like is true across whether you're established or emerging. It's like, I have to invest the capital, right? Like if you raise a fund, it's a, close-ended fund. It's, you have a finite investment period. It's usually 3 to 5 years. You have to deploy capital in that period of time. So it's like you're almost, if you close the fund, you're almost forced into this behavior, right? Like if you want to deploy that capital. and kind of, generate returns on that fund to invest, even if like the pricing has, shifted, significantly higher. So I think what's happened now, it's like a good opportunity because prices seem to be coming down, talent pools seem to be going up, and like a lot of funds, seem to be like, deciding they don't want to do this longer term. It's almost like a really good time to start a fund, like if you can get the capital and kind of launch it.
Yeah, I see that point. The supply of good founders, I think, is actually increasing from even the 2012s. It's becoming a lot more accessible, not just to become a fund manager, but also a founder. There's so many different platforms and groups and communities for people to encourage new ideas. And, with the rise of all of the support network for founders, it means that the talent pool is only going to increase. And therefore, like the fund managers themselves have a really high quality pool to pick from. And are really only like capital limited at this point. So I completely agree with the, and obviously we're in that same boat. So we're very hopeful that that is the correct path for us as well. But
it was so successful during the bull run that some VCs retired into their own family offices. Like that's when it was a good bull run. They're like, I don't even want to do VC anymore because it's too hard to fundraise. I'm just gonna like create my own family office. And that's like, there's multiple examples of that happening.
Yeah.
Winter, I want to kind of contrast this with something else that's happening, and I'm not sure if you heard the 20 VC podcast recently with the founder of Notion, but like this whole like big VC turning into, well, basically big banks, and the very large multi-stage funds having a lot of ability to pour money and deploy a lot of money, which has some interesting challenges for emerging managers who are unable to do so with smaller funds. What are you seeing as kind of the ability to compete for emerging managers? I mean, the obvious one is just go earlier and smaller and stay competitive with niche focus like we are. But what else?
Yeah, I know Nick from Notation. We were actually his anchor investor like 10 years ago. Love what he does over there.
That's amazing. I didn't realize that. That's really cool. When you were at Sapphire, I said Notion. I meant Notation. Thank you for correcting me.
They probably use Notion as a tool though. But I'm trying to get you sponsors for your next episode. What a great product, right? Should we talk about Notion, guys? Maybe the success of Nick Notation can sponsor the next episode as well. I'm just kidding, Nick. I think what's happening is there's a few things going on. I don't disagree with what Nick is saying, but I think there's a few dynamics. One is, rewind 10 years ago, and maybe again someone reach out from the woodwork and correct me here, but the biggest firm, the biggest VC firm was like NEA, right? At like $2 to $3 billion. Like that was massive, right? Like $1 billion fund, like that was the unicorn fund. There just weren't many of them.
That's right.
But when like interest rates went down, like, again, people are looking for yield. And so the people that had 10 or 20 or 50-year track records took advantage of that opportunity, right? Like that was a market opportunity to take advantage of. And so all of a sudden you had, similar to what played out in the venture-backed company ecosystem, where you went from like a couple of kind of unicorn companies to hundreds. The same thing happened in the fund world, where you had like a couple of these unicorn VCs with like, $1 billion plus in AUM per fund to, the top 20 to 50 funds now, right? Kind of raise billions of dollars. You also had like, again, people were looking for yield. And so you had people from later stage coming earlier. You had the earlier stage folks that again had like 10 to 50 years of track record that were kind of getting bigger. You had the rise of the mega round, right? People trying to like cram dollars into these bigger rounds. And like, if you have a bigger fund and you're kind of set on these like ownership targets, right? 10 to 20%, 30% ownership targets for the fund, which is almost like a mandate for bigger funds. Then you kind of, you had this dynamic of, right? Like basically pricing it and giving kind of the requisite amount of capital to get that ownership target and kind of deploy billions of dollars at the same time, right? I think the other thing it kind of does is it kind of pushes out the duration of companies, right? Because all of a sudden, like $1 billion exit doesn't return your fund. You need a $10 billion, right? Mm-hmm. So you go from the ecosystem, kind of everyone's thriving off of a unicorn exit, to, right, like, oh, we actually can't exit at unicorn prices. We have to wait for decacorn pricing, right? And this has been known for decades, right? Like, this isn't new. It's just like, it's math of how you return a venture fund. Like, if you have a bigger venture fund, you need to generate more market capitalization and exit at those prices, right? But there aren't a ton of buyers, and it doesn't feel like there's a ton of intention to like IPO for a lot of these companies. And so, yeah, you kind of have this kind of, longer duration, again, less liquidity, which again, it seems to impact, maybe that's the impact we're feeling now in the current market, but it does seem to impact the market in a significant way. Maybe that means like there's a bigger opportunity for secondaries, right? And it's a whole other kind of can of worms and conversation, but maybe that does like kind of point to, the increased kind of interest in kind of secondaries, and like, what does that mean for a private market that acts more like a public market, right? Especially if like there aren't a lot of big buyers for these big companies, but they're still growing, generating revenues, growing year over year, right? There's not a lot of kind of IPOs relative to number of unicorns, like VC-backed companies that are valued at like $1 billion or more. So it's like there almost has to be something else. Like there's a tension in the market that has to be like solved by, maybe it's the secondary market or something there that kind of solves it. But you do have like these bigger firms. That's a true dynamic. Then you have firms that have been very successful, and they became kind of multi-strategy firms, right? Because once you build a certain I think reputation and track record in a certain strategy, very few, from my experience and my perspective, like very few firms would act like Union Square Ventures or Benchmark, right? As like the two classic examples of like, I'm not going to raise more than $200 million at a time. I'm not going to raise more than like, $400 million at a time, or someone like Foundry Group, right? Like, I'm not going to raise more than like, it was kind of like it was almost like a testament to like it was almost like a proudful thing to do. Right. It was very interesting to kind of see like these minority of firms. They were incredibly good and still are, like what they do in terms of investing. But you had the rest of the market that was almost like the, super minority. But you had the super majority of firms say like, hey, if I'm successful, I'm going to scale up. Mm-hmm. And then, you kind of hit a cap on a strategy. And maybe that strategy is early stage Series A. Your cap is maybe at like 500 million or $1 billion. So then where do you go from there? Maybe you raise like a growth fund, or maybe you raise like an early stage fund, or maybe you raise, a fund in China or India or Europe or Israel, right? And so I think that was kind of the dynamic happening over the last kind of 10, 15 years, where you kind of had these, I wouldn't call them one-trick ponies because they're very like skilled teams. But they went from like a single strategy to multi-strategy. And then like you saw the AUM from an objective perspective, it was like, wow, that's lots of AUM, but it was multi-strat. It was across like different pools of capital. And then you had so much success there that some of those platforms, some of those multi-strategy platforms that formerly 20 or 30 years ago just used to be like Series A investors, they kind of were able to create their own parallel asset management firm, right? The partners were so successful that they almost ran like parallel asset management firms, right? And then you'd like, at that point, multi-strat, early growth, different strategies, parallel asset management firm. Like, you become like this bigger asset manager, right? You're no longer just a Series A venture capital firm. And so I think that's kind of the bifurcation that's happened. There's still emerging managers always coming to market, but emerging managers are really focused. It's like, this is what I do. I thread the needle on pre-seed, robotics companies. I'm raising $40 million. Great. Boom. But then like, as they scale up, become successful, they reach a couple hundred million in AUM, you probably start to think, okay, I am been in the market for 10 to 20 years. I see everything. I know I see everything. I've got great discretion and perspective. Why don't I raise like another fund? So there's strategy creep, but it's almost like deserved because like you've generated performance at that point for, 1, 2, 3, 4 decades. And I think, again, zero interest rate environment, like people took advantage of that and kind of scaled as quickly as they could. And I think that's kind of what what you've seen. And so, yeah, it feels like a lot of the bigger firms now have like, multiple strategies, multiple efforts under, a single name.
Mm-hmm. And so, like, given that trajectory that you've just mapped out, it seems like there will always be a gap for emerging managers as they enter the market in that case. And therefore, this is something that coaching new managers to start funds is going to be a perpetually important facet of the venture capital economy, like for many, many decades to come.
Yeah, people that know me, like I just try to call the spade a spade. One of the most famous slides in any kind of emerging manager slide deck is, hey, look at me. I'm Mr. or Mrs. kind of emerging manager. I exist in this geography or strategy. Look at all the success that's come before me and how big they are now. And look at me, I'm just like the small version of like the old super successful firm that's grown up, right? Very famous slide, right? And I've seen that like geographically, strategically, industry wide, right? So yeah, I think there's always an opportunity. Like that opportunity has to exist. You can't just like, put together the slide and hope magically like alpha is going to appear. Like there has to be like an actual investment opportunity there. But I do think there's something there where, again, what is the truth? From my perspective, the truth is, like I said, the super majority of firms, if they're successful, raise more capital.
Mm-hmm. Mm-hmm.
They don't stay the same size. There's kind of, again, like there's this story, this narrative around great firms stay the same size. Most of them don't. They scale up, right? Or they go multi-strat. And so because of that dynamic, right, if you assume 99% of funds, if they're successful, raise more money, and 1% stay the same if they're really successful, then that like those 99% are going to grow up to be bigger funds, and you're going to have your opportunity. As long as that opportunity still exists in your investment strategy, like you're going to have that opportunity to kind of take advantage of that with a smaller fund, right? They go from pre-seed to seed, they go from seed to post-seed, they go from post-seed to A because they've grown up. Who's doing pre-seed, right? It doesn't make sense for them to write a $250K check anymore. It makes sense for them to write a $2.5 million or $10 million check.
Yeah.
Winters. So this is super interesting. And like, if you talk with serial LPs, like LPs that have done a lot of LPing and not just like one or two LPing and mostly directs, many of them will say like that the beta that exists in the entire venture market is what it is, but the alpha that exists in emerging managers is highly correlated with the alpha that exists in sub $100 million funds. So have you looked at data around that? Like the funds that mature to fund 4 or 5 and stay sub 4 million, do they still outperform venture as a whole? Like maybe some of the ones that you mentioned earlier?
Yeah, I don't think it's maybe in the 2020 to 2022 timeframe. You had some of these like super hyper growth stories on the venture fund side. So you go from like 10 million to 100 million to like 500 million. I don't know. That's like really aggressive. I think more realistically, fund over fund, if you're successful in a more like normal fundraising environment, you're probably growing at like 25%, right? Like if you're a $20 million fund, like your next fund is 25 or 30, right? Maybe you grow at 50%, 25 to 50%. Like if you're super successful, like again, the expectations kind of shifted in a bull market where people just saw like, oh, I'm successful, I'll raise 3 times the amount of capital, right? But again, the way a serial LP, I believe would think about it is, what is the opportunity that this manager is taking advantage of to generate alpha? And is it still at a $20 million fund? And if you went from, let's say you could 3x the fund, if you go from 20 to 60 million, how does that change your strategy? It changes the check size you have to write. It changes if you don't change the check size, then it changes the number of companies you have to manage and keep track of, right? Which can kind of like dilute, I think, your kind of value add, right? It could dilute like your diligence because you're investing into more companies. And so, or it can like pull you into another stage, right? And so maybe they would argue Series A is more competitive than seed. I know some would argue that seed is like super competitive. But maybe if you stay at 20, 15 or 20, like you can invest and build out a really great portfolio that could generate true alpha by writing small checks, initial rounds. Like you could gather some data, early data, and like you could, play in the right networks and access like really great opportunities and generate a 5 or 10x return. But again, like if you generate that 5 or 10x return, then you probably have options. And so your option is like, okay, like you have to make a decision. Do I raise another $15 or $20 million fund and generate another, 5 or 10x, right? And I think, do I have higher probability of doing that? Or, do I just take advantage of the 10x fund I just put up on the board and raise $100 million? But again, like a serial LP is going to view it as, okay, is this person ready to kind of manage a $100 million fund? How does it change the strategy? How does it change the prospects of returns for that fund? And again, if you're going from 20 to 100, you're probably going from like pre-seed maybe to A. And so then you're going to almost be measured at a different, just like in a different realm. It's going to be like, okay, how good are you to win like a multi-million-dollar 7-figure check into the best founders and best companies in the world, vis-a-vis all of these multi-billion-dollar platforms, right? That can promise they're going to like stick with you because they're multi-strat all the way through IPO.
Yeah. I think there's definitely a bifurcation of strategy. And I want to circle back to those that are kind of just starting out in the field of doing their first like kind of pre-seed fund in the very early, fund sizes that are like less than 25 million. And given all of the history that we've just gone through and all of the market dynamics that we've just talked about, what are the main pillars of creating a successful emerging fund? It sounds like, there's so many different facets, I think, to what we just discussed, but understanding the market dynamics of like the later stage folks deploying larger checks at later stages means that there's a gap in the early stage. But how do you actually stand out inside of the early stage, given everything that you've seen, Winter?
Yeah, it's a great question. It's like the time-old question. What makes a great emerging manager? What makes an emerging manager stand out? I think you can answer it in a few different ways. So one way to answer it is like, how clean is your story, right? And again, I think that might even be like a controversial point. But if your story is like super clean, you got all the right brands around the table, you worked at VC-backed hyper-growth companies that were super successful, in the right roles, right? Like you're kind of like one of the insiders there, and then you come to market to raise a VC fund, like you stand out, right? Again, you have to package that the right way. But again, like you've kind of already done it, right? Like people can't take that away from you. It's kind of like, what is your competitive advantage? Like I've invested and been successful in Silicon Valley for 30 years. Like people just can't wake up one day and say like, you know what, I'm going to create 30 years of experience in Silicon Valley and like, go to market with a fund. It's like, that is a competitive advantage. And that, I think those funds are, for better or for worse, what a lot of institutional LPs look for. It's like, are you spinning out of a great firm and have this track record, or have you played an instrumental role in one of those hyper-growth success stories, mega companies, even if those companies haven't exited, right? It's like, you don't even have a perspective necessarily on kind of capital markets or generating returns for your investors, but you've seen the hyper-growth story, right? And so I think those are kind of the obvious ways to stand out. The other way to stand out is to be a little bit different, right? The different is better than better. And so thinking about like what different means, it's not, again, reinventing the wheel, but it's like understanding kind of how to bring something to market that is a competitive advantage for you. Like maybe in your case, it's like how many patents you have and your understanding of being able to evaluate technology. Like a lot of VCs would rely on third parties or other people to do that. You have it in-house, right? So it's kind of like understanding what your competitive advantage is and really kind of like, talking about that as like a key differentiator. That makes you stand out, right? And understanding what that superpower is, I think is very important. Another way to stand out is like, what are the cool trends, right? Like what's hot and buzzy and being written about and all the, the best rags. Like, I think that is another way to stand out. Again, for better or for worse, like I've seen, right? Like if you talk about it, and it's funny, like if you take a step back and you look at hundreds or even thousands of pitch decks a year, which I do, it's like you kind of see the trends. Like it's like, okay, these are the trends and like the hot topics. And for better or for worse, like a lot of people take advantage of that. So it makes you, in the beginning, it makes you stand out. And then there's like, right, it's some type of curve, some type of, Harvard Business School research study that is above and beyond me. But there is like if you catch that in the early days, right, you stand out because it's like you're first to the party. And then all of a sudden everyone like realizes it's like the coolest party and they show up. Then it's like, okay, eye rolling at some point, like along the curve. But if you get there early, it's like a way to kind of stand out. And then like another way to stand out is just like pure performance, right? Like, the way I kind of give feedback on this is like the show, not tell version, right? It's like you can talk to people or you can like show them what you've done, right? And I think if you are able to kind of show, not tell your strategy, that's kind of what when LPs, limited partners kind of say like repeatable strategy, right? Like you're showing that something's working here, right? And then I think people can get excited, right? It's the same thing like if you're betting on a company, right? There's few people that'll bet when it's just a team. And then like most investors, right? Like if you look at the capital stack of a company, most of the investors invest when there's like proof points, right? So as an emerging manager, how do you stand out? Show that it's working, right? Whatever that strategy may be.
Yeah, I love that. So different ways to differentiate yourself within already high quality individuals. It's not just the fact that like you've done something interesting. It's that you've done something interesting in a market that is nascent, that other folks aren't necessarily interested in yet, but you've shown track record of progress. I think that's super clear, actually. If you have all those things, I think one thing that became very clear after we went through the Coolwater program is like, that's all fine and dandy, but also actually operating the fund is sometimes a huge pain in the ass and a challenge as well, that a lot of fund managers, before they start an institutional fund, they like don't even know how to begin. I'd love to like touch on the back office challenge of a new fund manager as well, and sort of how Coolwater has helped their funds like navigate that space.
Yeah. So again, setting the context for the current market environment. Bless you. There's thousands of funds out there, right? And how are you going to stand out fund over fund? I think one of the complexities there, one of the challenges is it gets more complex over time. So you might not feel it at fund one, but if you're managing 3 funds under the same roof, under the same brand, under the same strategy, like it starts to get pretty complex, and like you're going to need a support team there. Another kind of, I think, disconnect still in the market, and this is when I pull out like, I put on my gray mustache, I pull out my rocking chair, and I kind of like sit there, rocking back and forth with the cane, with a raspier voice. Like the disconnect in the market is like, I think between, this is an exciting debate, like between institutional LPs and their expectations and emerging managers, right? So we've actually at Coolwater, we've created an OCFO service to kind of fill that void. Because like when I talk to institutional LPs, most, if not all of them would agree that the reporting requirements and expectations and delivery from emerging managers is subpar, right? So again, if you're a serial LP, as you're calling them, and you're investing into the best private equity firms in the world and the best kind of, alternative asset managers in the world, right? That's your expectation. So like right. I have 100, 200 funds in my portfolio, maybe more, right? Like that's a lot of kind of data to kind of say like, who's the best at reporting and who's not the best, right? And I think emerging managers can do better on that front, right? Like that starts with kind of building kind of, the right data infrastructure, knowing kind of the business processes, knowing what the expectations are, and actually like having a system in place to kind of right, manage that and deliver on, institutional LPs expectations, especially if you want to make that jump from, again, the market context of thousands and thousands of emerging managers that want to grow up and be institutional, but aren't willing to kind of like spend the dollars against their fund to be institutional, right? And so I do think that's a disconnect right now in the market where, again, some people are just well enough connected to capital networks where it doesn't matter. Like they're going to raise because they have the capital network. But I think for a lot of the market, right, maybe the long tail, like that is something at least to consider is like, again, how do you pass in operational due diligence process with flying colors? How do you manage your back office so that when you're running 2 or 3 or 4 funds under the same strategy, you're meeting the expectations of LPs and future LPs that could be institutional or are institutional, right? Especially when like you're not competing against yourself, you're competing against thousands of other managers, and you're competing against some of the best private equity firms in the world that have multi-dozen or multi-hundred person IR teams, right? And they're delivering like the best practice. Like they're teaching the best practice at kind of the world's leading institutions. And it's like that should be the standard. And it's, again, it's not an overwhelming thing to do. Like these are very like fundamental things to do. It doesn't require all day long, right? But it's like considering that as like one of the pillars that you should be thinking about from a fund management perspective, right? Investing's one, fundraising's one, but like fund management as like a pillar of like what you should be doing as a CEO of your firm it's very smart to kind of like, again, at least understand what's out there and understand what the expectation is of the LP. Because I noticed that, a lot of LPs don't even disclose that that's like a problem. They just kind of say like, they just kind of, they've got too many things to do. So they're not going to be like, tell that VC, like, this isn't good reporting. They're just going to kind of not invest in that VC or just ignore that VC.
And how do emerging managers like figure out what they like? That's an unknown that most people entering this industry will have no idea even how to approach the question of. Like, as you've mentioned, LPs are not going to coach emerging managers on how to do that better. So what resources do they have? Yeah.
Drum roll. I'm going to answer that.
Please go for it.
As someone who dropped out of VC Lab and joined Coolwater Capital.
No shade to any platforms on our programs.
No judging. Yeah, I think the one key differentiator there was I do genuinely think that Coolwater Capital prepared us really, really well to be an institutional trajectory fund, right? Whether we raise from true institutional in this fund or not, like we've been told from many LPs that we seem to be like very, very advanced in our data room and reporting. But yeah, and I think a lot of that is thanks to Coolwater and the program that we went through last year winter with you and the team. So yeah, it was great.
I think it's also like Sabrina's ridiculously meticulous and you're like a power networker. So those are definitely like superpowers respectively. But yeah, like I've written a couple books, how to raise a venture capital fund, how to set up a venture capital fund, right? I've tried to put out literature in the ecosystem for the last kind of 10 plus years. We launched #OpenLP, which is more of like an aggregator of content than a generator of content. The accelerator program for Coolwater is kind of one mechanism to kind of help people understand this perspective, right? Like the OCFO service, and there's other OCFO services out there, but ours is specifically geared for emerging managers who want to kind of bridge that gap and kind of manage institutional capital and manage kind of complex portfolios and meet those institutional standards for LP reporting.
It's just knowing that there are the resources out there and like where to find them, I think it's like half the battle when you're just getting into this industry. So yeah, really appreciate that you have all of that out there, Winter. I agree. Yeah. And I think the back office it's one of those like necessary evils. I think when entering this industry, everyone enters because they want to like help founders and help people like realize their innovation dreams and like change industries in really meaningful ways. But the fundamental need to be an actual institutional fund when you're taking capital from larger LPs cannot be understated. Like it's literally like the job, and it's often not highlighted when people get into this industry. So thanks for providing all those resources for folks like us. I think there was one other aspect that I wanted to get your feedback on, And you mentioned that you have a US chapter of Coolwater and that you're potentially going international. And I'm really curious, like, what is going on US versus international right now? And like, can you speak to the opportunities that you're seeing?
Yeah, so we just launched a cohort in Japan. And so, what I've noticed kind of building Coolwater in the US is probably about 10 to 15% of the community is international. But I do think of the Coolwater opportunity, which is intersecting with discovering, working with, helping support, helping build, helping co-build some of the best investment managers all over the world. Like if only 10% of the people in kind of call it the US cohort, I just don't feel like, I feel like there's more, I feel like the world is flatter than that. I feel like there's more opportunity and more great investors in different ecosystems, right? So, Japan, fourth largest economy, right? They get between probably on a global basis, like 1% to 2% of the venture dollars, right? But think of them from like an innovation perspective, from a corporate perspective, from an economic superpower perspective, right? Like I feel there's opportunity there. And, the Coolwater model is like a potential to help some of these geographies, build new venture firms, right? And potentially offer like a new way that's different than a traditional accelerator. It's an accelerator for funds. Like it offers a new way to help support the capital markets ecosystems in those geographies. So we'll, continue to pull on that string for a little bit. I think there's some structural things where a lot of what we do, right, is focused on co-building, it's synchronous training, right? It requires kind of us to be in the same room together. So if you were to take this to Japan or take this to India or take this to another country, sometimes it is like a time zone issue, right? Like you've got a family, are you going to wake up at midnight and kind of work with Coolwater for 4 straight hours to 4 a.m. and then wake up for your kind of day job the next day? So there might be some, if it's a synchronous training program, like there might be strategic opportunities to partner with different geographies around the world to really bring like a local version of this. And especially if it's geared towards early stage, right? Like something you'll hear from, I think a lot of people is, early stage is local, seed is local, right? So, again, Series A managers, Series B managers are going to be looking around, the world kind of for those opportunities as they emerge. But in the beginning, right, you're going to have 1, 2, 3, 5 rounds of, capital deployment into like great opportunities. So I think that's Coolwater's kind of positioning is like, can we go to different ecosystems and actually, partner with some of these governments or some of these local organizations and help, locally build or co-build a couple of these or accelerate a couple of these like great firms. The bar doesn't change. Like these are still, incredibly successful people that, have deployed, millions or tens of millions or hundreds of millions of dollars. They've put up really big numbers on the board in terms of returns, right? They've, been impactful kind of selling companies or building companies. So from like a Coolwater ecosystem perspective, for you guys to think about like personally, it's also like, how do we connect like a global ecosystem, right? And just keep it simple. Like if we keep the bar high, and qualify it and like great people come into the ecosystem, right? Like great people want to hang out with great people, want to be connected to great people. So I think it actually like augments the network power of Coolwater versus depletes it.
Yeah, absolutely. We've been noticing also that there's a huge hunger for encouraging innovation in different geographies, particularly Japan, particularly, different European countries. And the venture just maturity is just not there yet. But there's so many people that are hungry to get access to the ecosystem. And I think the other thing that we're seeing is that there's still a perception, I think even internationally, that like US is the only place to like build startups or build funds, and that I feel like is super limiting globally because there's so much happening everywhere. I mean, the best manufacturers are have become overseas so far. So, and there's so much opportunity in other verticals as well. And I think that finding a way to support the global ecosystem is incredibly important if the mission is actually to drive innovation forward, because we're missing out on huge chunks of the economy otherwise. So huge kudos to doing that. We're excited to see how that works out and excited to figure out how we can collaborate on that maybe later down the line. We are rapidly approaching the end of the hour. So Winter, thank you so much for all of the insights. And if it's not already apparent, Winter knows literally all the things about the venture industry, history, and figuring out the best strategies for emerging managers. And we're super grateful to have him in the ecosystem. But before we sign off today, Winter, I have one more question for you, just to show that even folks as amazing as you have had people along the way that have helped you. And the question is, who has the most impactful person in your career to date been, and why?
Yeah, I was thinking about this question throughout the pod. I'll kind of give maybe 3 stories. So the first is, one of the people that hired me at Hall Capital, Kirk Dizon. He's like a fund formation lawyer. And he was the one who got me involved in kind of the micro VC space. So more credit to him than any credit to me. But like, he was the one that kind of bet on this like emerging manager kind of category super early. He kind of taught me to like do it in a different way. Like the first day on the job, like we jumped into his car, drove down to Sand Hill Road. We went into kind of a prominent like VC firm's office. He sat down in the chair at the head of the table. He turned around and he said, "I'm going to fall asleep. Just do something like really loud when like the main partner like comes in." So like he fell asleep and started snoring, and I just like was petrified. And then like the person walks in, I had to like grunt or snort or, kick the chair. But again, like he was very successful and kind of did it in an unconventional way. But like, I'd say I credit him with kind of, getting me exposed to the smaller VC world. Second person, I give a shout out to Mark Suster, who I was actually texting with last night. But he was the first VC or PE person to actually like write me on LinkedIn and connect with me on LinkedIn. Like this was like 15 years ago. And I just remember it as being like an impactful moment, being like, oh, someone actually saw me in the room. Like, I think I was like an analyst at the time. Right. And I was like, oh my God, like he actually like knew like I existed. And so, but it's kind of, you don't know, right? Like it's how do you treat people like as you kind of move through the day? Like you don't know like who you're actually going to impact and how impactful that's going to be. But it was kind of just like a testament to like, even if you're a brand name kind of like VC or like no matter how successful you get, to just make sure that like the engagement across the ecosystem is, appropriate and hopefully inspiring. Mm-hmm. And the last story, I was thinking like Katie Hall from just like, Hall Capital, the name, but like, I remember sitting down for breakfast with her kind of one-on-one. This was, I think, a couple of years after I left Hall. And it's like, you're trying to discover the secret of the universe. Like, okay, what's like, I need to like, right. Like you're in that mode. Like, I just need to solve it. And sometimes like things are always going to be gray areas and you're never going to solve them. So I was like, I kind of asked her a ridiculous question. And I was like, what makes like the best VCs? Like, what's the secret to being like, the best VC? It was a 1-word answer: optimism. It's like that. It wasn't like, how well you ran your firm. Like, it wasn't any of this, like, we're going to institutionalize. Yeah. It was just like, I was like, how have you been so good at, like, have you built this rock star status of investing in the best private equity? And like, this was geared towards venture firms in the world. It's just like, yeah, I just find people that are very optimistic, and like the rest kind of solves itself. I don't know if it's that simple. Like there's a lot to do on top of optimism, but it's a good reminder, right? Like it's always going to be tough. There's always going to be like, hiccups along the way, but I think VC is about long-term. And so, the hope, the optimism, there's a lot in addition that goes into that, but I thought it was like a funny answer. So I don't know.
I love that. That's incredible, Winter. Thank you so much for sharing 3 stories. Cheers to all 3 of them. Thank you so much for sharing.
Yeah. No, this is great. Thanks both.
Yeah, I really appreciate your time, Winter. Simon, you want to sign us off?
Thanks. Sure. Sounds good. Yeah, that was incredible, Winter. It was great to finally have you on. And thanks for everyone for watching. This has been Beers with VCs with Winter Mead. Signing off, and see you next time.